Hello, welcome back. Alibaba reported earnings about a couple of hours ago, and pre-market the stock is up close to 5% right now. It used to be a little bit lower, like 4 to 3.5 or something of that sort. Seems like we're having an upwards trajectory, nice to see. But if we take a look at the stock news, you will kind of see here that Alibaba shares are rising. Alibaba shares gain after earnings beats revenue estimates as lockdowns spur online demand. Okay, we have talked about the fact that we are expecting less of Alibaba because it has been beaten down tremendously, and when this happens, generally speaking, expectations tend to be lower and they can be easily met, or if missed, they can be marginally missed and still allow the stock price to go higher. Now, this article talks about what is happening with Alibaba and their earnings report. They beat on revenue estimates on demand for niche China shopping services. So let's examine the finer details here. So as you'll see here, growing demand for some of its niche online shopping services in China offset weakness as its main marketplaces caused by the country's COVID-19 lockdowns. We have talked about the lockdowns. The company is still under heavy lockdowns for not a real reason, really. And so the stocks actually at some point were up about 5%. We will probably see it potentially a little bit later when the markets open. But revenue in Alibaba's cloud computing division rose 12% to almost 19 billion yuan in the reported quarter, and the core commerce unit revenue rose 8%. The company, however, said it would not issue a forecast for the new fiscal year, which I think they also didn't do for the previous quarter as well. Now, rival JD.com beat estimates for quarterly revenue last week. So, overall, Alibaba's revenue rose 9% is what they did right now, and analysts on average had expected revenue of close to 200 billion yuan. So they actually beat on that revenue rising, really. Very nice to see. I would actually expect it to be a little bit lower. It seems like they're doing well. Now, net income attributable to shareholders fell 59% is the deal to 61, almost 62 billion yuan in the fourth quarter that is ended March 31. Primarily due to losses associated with its equity investments in publicly traded companies. So that makes some sense here. Now, Ant Group, Alibaba's fintech affiliate, reported a profit of about 22 billion yuan for the quarter ended December, compared with 21.76 billion yuan a year ago. So we don't have guidance statistics. We don't have any guidance really reported from the company, but they have done well based on on the financial reports here, the financial report. Now, maybe this kind of not giving a guidance really will hurt them a little bit. Maybe it would have risen the stock price a little bit more if we had guidance. But I'll take it. And again, Alibaba is a company for the long run. It's not just a company that is about the earnings report. And this is why I don't pay too much attention in earnings. The earnings are more or less sort of like a temporary thing. And as long as the company continues its trajectory towards increasing sales, increasing net income, increasing free cash flow, I'm fine with it. And even a bad quarter doesn't mean much. It may actually mean that you are getting a better price, a cheaper price. Now, we have talked about Alibaba, of course. It's a fantastic company. It's a cheap company. They are buying back tons of shares as well. They have reported a $25 billion buyback some time ago, from 15 billion actually, so they have increased that. And so they're going to be buying about 10% of their market cap pretty much. So they're going to be buying about 10% back of their outstanding shares. And so this will be fantastic for investors because they are going to be getting their stock prices to be intrinsically higher in terms of what they're worth. Now, just quickly, we can take a little bit of a closer look at the stock evaluation tool. I have done it multiple times, but since we got the earnings report now, we are heading at about, what was it, to 85? About 85 bucks, I would assume. Maybe a little bit more, 86 right now. Maybe it's going to be 87 or something. So we need to bear that in mind. And the revenue growth for Alibaba, again, remember that we just saw that the company achieved 9%. Let me find it here. That is the overall revenue. Alibaba's revenue rose 9% here to 30 billion in the quarter for the quarter. So we got 9% revenue increase in the first quarter really here. And what can we do with our projections here? Alibaba, generally speaking, has been doing 40%. And with this 9% right now, they're within that ballpark range, I am assuming. Although I would have to see the previous year quarters as well, just to because not every quarter is the same, of course. But since we're already having 9%, it doesn't make a lot of sense to go 9. Although somebody could say that they are expecting revenue to drop tremendously in the next few years. I don't expect that to be the case. Yet I will still be pretty conservative here. I will go with something like, let's just go 12, 14, and 16. And as you can understand, these are very, very conservative values based on what, compared to what Alibaba has been doing in the previous years. Now, the net income margin here is 20, something like 20, 23, and 26%. 20, 23, and 26. And the free cash flow margin like 90, 100, maybe. Whoops. Let's go actually 90, 95, and 100. And 13% for our annual return is what we want to be making. And if I hit calculate, let's see what we are getting. Yeah, so the low estimates are going to be 156, 205 for the medium, 264 for the high. Alibaba is a fascinating story because even if you set 0% in the revenue growth here for everything, I mean, if I set 0 for everything, I'm probably getting the same value here. So yeah, there are different net income margins, so that changes slightly, but it's very close. And so even for revenue growth of 0%, you're still getting 94, almost 94 bucks, 114 and 135. So we already had 9%, remember, and with 0% revenue growth every year for the next 5 years, we are still in the green based on the current price, which is going to be around 87. So this company is just insanely cheap right now, and based on what they are doing financially and what they have been doing financially, because their balance sheet is also amazing. We have talked about it in the past. It's absolutely stellar here. You will see amazing stuff. Retained earnings growing from 15 billion to 85 billion here. And the company's total equity growing from 46 billion to 163, 4 times as much, quadrupling their assets here. I love to see that. This is a company that is a massive buy. This is why I have bought it. And my cost basis is, I believe, around 118. And I truly believe that this company has a lot of potential for the future. And in the next maybe 5 to 10 years, I think it's going to be a massive winner, really. So, thank you for watching this one, a little bit of an update on what is happening. Frankly speaking, again, an earnings report is just a temporary thing. It doesn't play too much role. It just gives us a little bit of, let's say, a pat on the back for Alibaba. But it's all about the long run and just a company that makes a better balance sheet, increases their top and bottom lines. This is what we want to see. Not really the price right now, which is very low. This is just the thing that allows us to buy more stock. Thanks for watching, and I'll see you in the next one. Remember to like and subscribe. See you soon. Bye bye.